Widespread carnage continues across the global economy as the continued tariff trade war uncertainty between the US and major trade partners remains unsolved, and trade deals still remain in the balance with no certainty that any agreements will be made. This is having a major impact on some of the largest freight shipping ports, which are seeing a steep drop in container vessel traffic. The number of freight vessels leaving China for the South California ports is down about 29% week over week for the week ending May the 3rd, according to Port Optimizer. And year over year, the data shows a 44% drop in vessels scheduled to arrive in the week of May the 4th to May the 10th. And now we are seeing the CEOs of America's top retail stores, including Walmart and Target, warning President Trump that a prolonged trade war would lead to shortages, meaning empty shelves and higher prices for American consumers. Casey Armstrong, the CMO of the global fulfillment and supply chain platform ShipBob, has warned that the first signs of empty shelves would be where the price-sensitive imports dominate the shelf, like toys, games, budget home goods and apparel. Now, these products will disappear first because of shortened lead times and the fact that they are the lowest margin, fastest moving goods. Now, retail isn't the only area suffering from trade war tariffs though, as farmers are now saying that US agriculture is in a full-blown crisis already. US agricultural exporters say that the global backlash to the tariffs is punishing them, especially through a decline in Chinese buying of US farm products, leading to cancelled exports and layoffs. And recent data is showing that China has cancelled 12,000 tons of pork shipments, the biggest cancellation since 2020, while other types of products like wood pulp and grass seed exporters are also suffering from Chinese cancellations as well. Many companies across all types of industries are extremely concerned about the way that things are playing out right now and are warning that revenues and profits will be hit. At least a dozen companies have cut their full-year outlooks so far this earnings season, projecting that tariffs will weigh on their profits and put more pressure on an already shaky consumer. For many companies, tariffs means higher costs for key commodities that are used to make the products, which means that many will have to go down the route of offsetting these higher costs by charging consumers higher prices. But with so much uncertainty in the economy, consumers are pulling back their spending, so this is going to end up in a situation where companies are making less profit, but consumers are still forced to pay higher prices. The US Consumer Sentiment Index just fell by 6.2 points to 50.8 in April, the second lowest point it has been in history. This is also lower than the 2008 global financial crisis low, which clearly shows just how bad consumer sentiment is right now. With consumers being so scared about the current economic conditions, they retreat away from spending to instead stockpile more cash, meaning that they will be spending less in the economy, especially if prices go up. Now, we are in fact already seeing signs of the economy cracking, looking at the new GDP figures that just came in negative growth for the first quarter of 2025, with the US economy shrinking by 0.3% at an annualized pace. This is largely being driven by a surge in imports of 41.1% ahead of President Donald Trump's tariffs, with imports being a component that is subtracted from GDP. This is the first quarter though of negative GDP growth since Q1 of 2022 and falls below the gain of 0.4% that the economists surveyed by Dow Jones had been predicting, and it also falls much below the 2.4% rise in GDP that we saw in the previous quarter at the end of 2024. Now, Jamie Dimon, the CEO of JP Morgan, has recently been very outspoken in interviews talking about the Trump tariffs and the escalating trade war, issuing a frightening warning about where he sees things heading in the future. Dimon believes that the US economy is facing considerable turbulence, with the odds of a recession now rising so much, mainly due to the sweeping tariffs increasing domestic inflation and also hurting the US's economic alliances, that Dimon now believes a recession is a likely outcome. He expanded on this, saying, if the Western world's military and economic alliances were to fragment, America itself would inevitably be weakened over time. Dimon also believes that earnings for US blue-chip companies would fall and many management teams would pull back on financial guidance in the weeks ahead. He added that economists are probably right that the economy will experience a slowdown, and when asked how significant of a slowdown, are you seeing defaults, Dimon did respond by saying, not yet, but I expect them, which is a concerning sign of potential things to come in the future. Now, Dimon then did go on to suggest that companies could soon be reducing their workforces to cut back on costs, actively trying to slash their expenses. But JP Morgan is not the only major bank who is becoming increasingly bearish on the US economy, as we did recently just see a big statement from Bank of America, whose strategist did warn that investors should sell into rallies in US stocks and the dollar, cautioning that the conditions for sustained gains are missing. The team led by Michael Hartnett did say that the dollar is in the midst of a longer-term depreciation while the shift away from US assets has further to go. And they believe that the trend will continue until the Federal Reserve starts cutting interest rates, as well as the US reaching a trade deal with China and also consumer spending staying resilient. And another global bank, Deutsche Bank, is also warning of a major structural dollar decline in the coming years, which will knock the US currency down to its weakest level in more than a decade against the euro. Now, the dollar did fall to a 16-month low last week as heightened US policy uncertainty fueled questions about its status as the world's reserve currency. And strategists at the bank did say, the preconditions are now in place for the beginning of a major dollar downtrend, adding that the negative impact of US tariffs, alongside Europe's reassessment of Washington's role on the world stage, will lead to investors to unload US assets and drag the dollar lower. We have also seen Ray Dalio, billionaire and founder of Bridgewater Associates, be very outspoken recently, saying that he is worried about something worse than a recession happening, stressing his concerns about the possibility of the global monetary system breaking down. He did say that Trump's tariffs are being implemented in a very disruptive way that creates global conflict, which combined with a growing national debt can lead to an imbalance in the supply and demand for US debt, and the results of this will be worse than a normal recession. He even emphasised that a breakdown in the bond market, combined with events like internal and international conflict, could be an even more severe shock to the monetary system than 1971 and the global financial crisis in 2008. Hearing such strong warnings coming from someone like Ray Dalio, someone who is so knowledgeable and established in the world of financial markets, certainly is very alarming. Now, this debt supply-demand imbalance that is mentioned by Ray Dalio here is certainly one of the biggest threats to the future of the US economy now that geopolitical tensions are rising with the US. And foreign holders of US treasuries could look to use this as an economic weapon to pile huge financial pressure on the government, who are now paying higher and higher interest on their debt, on a debt pile that continues to surge at a record-breaking pace. My previous video goes into more detail on this topic, and you can check it out by clicking on screen right now. Aside from that, if you enjoyed the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.